right, let's go. Hey, Bill Bodnar, welcome to the Walk Podcast. Thanks for carving out some time in between rooting for your New York Football Giants.
Don't say that. I mean, I'm rooting hard, but thank you. It's great to be here. Thank you to you and Tom. I'm enjoying this.
Well, I'm excited, and we try to keep these relatively short. Whenever you involve Levin in any conversation, there's the possibility of a 2x or a 4x multiple on how long something should possibly last. But there is a lot to talk about on this one. And what I'm hoping for, and when we end, Bill, stick around, let you and I talk a little bit after this, because when we end, I'd love to look for some opportunities to just leverage you from time to time as we get into 2021 and not make this a one-time kind of thing. But there's a lot that I could do in intro, but if you don't mind, give us 30, 45 seconds as it relates to you, your background, and Tabrasa and what you're currently doing with Mortgage Market Guide.
Yeah, sure. So, Tabrasa is a firm that had a couple of evolutions over the last, goodness, 20 years, since Mortgage Market Guide, and there was Loan Toolbox that was out there, and they were packaged and sold to a company and resold again a couple of years later. And so, over the last couple of years at Tabrasa, we've been re-engineering all our software. And, in fact, one of those products, obviously, is Mortgage Market Guide, which I play a big role in and day out. And we just launched a new desktop version, mobile application for that, and still have, a very loyal, faithful group of subscribers to it. So it's been good. It's been good.
No, that's great. And I've known you through some of those changes, right? And I kind of forgot how far back Mortgage Market Guide goes through various iterations and evolution. The connection with Mortgage Market Guide and Tabrasa, is that all under a single umbrella now?
Mm-hmm.
It is.
Yeah, that's exactly right. Yeah. So we provide different solutions. We have mortgage, you think about the front end of what a salesperson needs to go about their day. We have everything from the lead management, automated marketing, a loan presentation, the market intelligence, which is Mortgage Market Guide, flyers, everything that they would want, and bringing more to the market, some home monitor capabilities, a point of sale. So it's try to give the loan officer everything they need in one spot and offer it in a modular way. That's the theme.
I was talking to somebody last night that's a client, a $5 or $6 billion independent mortgage banker, and one of their regional presidents. And I said, hey, I'm going to be talking to Bill Bodnar tomorrow. Do you know Bill? And he said, gosh, how do I know that name? And I think that's probably true with a lot of people that I would talk to, where they've seen your posts, they've seen your videos, they've seen some of the analysis that you've put out, and they know the name behind it, but they maybe haven't spent a lot of time with you one-on-one for whatever reason. And I would suspect that that's a lot of the industry. So I know I've leaned on you, and companies that I've worked with have leaned on you for the analysis and the guidance and the intelligence that you provide. One thing I think of when I think of Tabrasa and you specifically is that, as the industry has evolved to more of a tech-friendly industry, right? That there's this thought that I always have, which is loan officers, managers, people like me and what I do, we might be really good at what we do with the blocking and the tackling, right? But to be really, really efficient across all of the things that our customers expect from us and our referral partners expect from us, technology and that guidance makes us better than what we could be on our own. And I feel like you absolutely and Tabrasa fall into that bucket.
Yeah, I mean, you think about the space. We have all this technology. And we're trying to do it to drive efficiency. But the one thing we forget is that providing value during that customer's journey is the biggest thing. And we can send out marketing and a lot of flashy stuff, but at the end of the day, it's sales. It's blocking and tackling, and bringing value. And if you bring value, you win partners. And when you have opportunities in front of you, you don't lose them, right? Your close rates just go through the roof. No one's going to leave you if you're providing guidance, right? You go to a good doctor, you're not going to start questioning them, start chiseling them on fees and things like that. You go and you're like, wow, I don't want to miss anything, so I'm sticking with this person. So it's important to have this stuff. And the great part about it is it changes. I speak to a lot of leaders like yourself. They want their salespeople to be speaking in real time. What's going on right now? Tom's going to speak to me and say, I'm in the mortgage business. Where are rates going? What's happening? And
right.
There's so much, so much to talk about. It's easy.
So
I
if
just
you're,
want to know about
go
those
ahead,
lumber
Thomas.
prices.
Oh, you want to know
Can
about
we talk
lumber?
about lumber?
Yeah, I saw lumber futures went up recently again.
I love your videos, Bill, because I'm not 100% financial industry market savvy, but when I watch your videos, I feel like I know what's going on, and I've never heard anyone talk in my life
Well,
talk about lumber prices, and it's super interesting because I built a deck and I realized how much lumber actually costs.
that was
No
the thing,
kidding.
Tom.
Right?
And the lumber prices, by the way, and now it's morphed. It's not just lumber, right? Inflation expectations of, asset inflation is going up materially. You can kind of dig into it now. And lumber is something that was like a perfect storm. We had the mills close in the spring due to COVID, and then all of a sudden we have this explosive demand, and builders are scrambling. And lumber, the price went up 3 and 4 times. It leveled off, but is now going up again. And not only that, but there's scarcity in other materials. I mean, everything's gone up. Copper. So the prices of homes are going up. And what's unbelievable, if you listen to Toll Brothers yesterday, their CEO is out. They're raising prices continually. It just keeps on going. There's just a lot of money out there. There's incredible demand. Prices are going up. And what I would tell the listeners, if you're talking to a borrower now, it's a great nugget that, we've never had inflation. You're talking to millennials, we haven't had inflation. And there's really smart people on both sides of the argument. Is there going to be inflation? Is there not going to be inflation? Well, the Fed has changed their approach towards it. We used to have, a target of 2%. Gets 2% or it gets close to it, the Fed would hike rates and kind of stomp it down. So we've never really had inflation above 2%. They have now removed that. They want it to kind of float. They want it to get north of 2%, kind of linger there, stay there a while before they even consider a rate hike. And that's why the Fed is probably not going to raise rates for years. But there's a saying, don't fight the Fed. If they get what they want, inflation's coming. So if inflation's coming and you're a renter, in an era of inflation, everything goes up. Wages go up. So we will all make more money because it's just how inflation works. But you will be taking that money to pay an escalating rent. So you'll take your rising wages to pay off your higher rent.
Right.
Well, that's the opportunity screams today that you should be buying a house, and you lock in a mortgage that is being artificially held down by the Fed. Let's be honest. If the Fed wasn't buying $120 billion worth of bonds, rates would already be a lot higher. So you take advantage of the Fed, you lock in your rate now, and should inflation come, because we just don't know, but if it does and the Fed wants it, you will be paying off that low mortgage locked in at a rate with an ever increasing wage. So you start to inflate your debt away. I mean, do what the banks do. And then on top of it, when inflation, real estate is such a great hedge. It's an unbelievable hedge. And that's why you're seeing such demand in housing. It's out there. People are like, I got to get into a house. I got to get out of renting. And so housing looks great. We'll talk a little bit more about it, but that's a quick inflation story.
And there's a lot, I have a lot on my list and we don't have enough time to get through it all. So we'll table some things and maybe come back to you in a few months and do this again. But sticking with the thought that you just had, is there, I mean, I'm thinking about like if I'm an originator and I'm looking at my database or I'm thinking of my local community and the way that you just described how to communicate with a renter, can you dumb that down even more? Like when you coach a loan officer on the low-lying fruit that exists with that possible consumer base, are there ways that you coach them to do a better job of communicating with them to convert them from a renter to an owner in today's environment?
Yeah, I mean, again, when you start, if you want to be an advisor, I used the word, I think you used the term before, and advisor, somebody that's bringing value. You take a renter, and I don't know the exact numbers, Eric, but it's well documented that if you look over, your financial well-being at the end of the road, people that own a home do better than those that rent. And that's even in this environment where we haven't had inflation for 40 years or any threat of it. If inflation does indeed rise, I would take my sister, my brother, and just say, listen, here's how this inflation works. Everything goes up, your wages go up, it's gonna be great, but you're gonna be taking that money to pay these rents. Everything goes up.
Right.
You would wanna, you have to, your largest expense is obviously your home, right? It's the biggest expense we have. Why not lock in a purchase and buy a home? And then on top of that, what I'd be sharing is, and it's easy to sell, especially here, I'm in New Jersey, you're in the cities. We have this migration, this tailwind, people moving to the suburbs. The home has now become more of, I'm working. I mean, you can see me, forgive the background, but I'm in my teenager's bedroom, right? We're all hunkered down. I'm actually quarantining right now. I actually have a person in the house with COVID
Oh,
at
wow.
this moment. And so I've been in, literally, I haven't seen my stepdaughter in like a week, just passing by in the
Wow.
hallway. So, the house has become a work space. So
Right.
it's different. It's different. And I think sharing that story and painting that vision is just so critical. But understanding how inflation works is something that all of us, I mean, inflation is the driver of rates. If inflation goes higher, the Fed will be under heavy pressure to do even more, because inflation is the tide that rises all boats. So you have to have a working knowledge of it and its effect on real assets and money and interest rates. It's important, especially
Well, and look,
because it's
and
fundamental.
the reason why someone like you is so important is that you understand these things as an economic professor. I'll sort of describe it. And then if I'm a student in your class, and let's say I'm the loan officer, I'm the student in your class, I understand it at the level that I kind of need to understand it. But then communicating that to a consumer who kind of doesn't care they don't think they should care so much about words like inflation and Fed funds and the rates, and you do a really good job of helping that originator or the organization communicate, to Thomas's point about lumber prices, to communicate it in a way where, oh, now I can run that math. I get that formula. I understand now that this would be a smart decision to make this leap and go invest in this property, that's in this home that's ultimately going to be not only my emotional hub, but it creates financial stability for me in the future. I don't think most people's brains are there right now, though, right? Because we watch the news and all the consumers that you're talking about, for the most part, all they're hearing is negativity, where they're hearing about vaccines and we've got a new administration coming in, and did the election get stolen, did it not get stolen, what's going to happen with COVID, that they're hunkering down a little bit
Yeah.
more, when you're suggesting, which I know we would all agree, now is the time to actually move on some of these opportunities.
So that's a great point, and it really bleeds into a whole other conversation we can get into here. And the saying in the markets, be fearful when others are greedy, right? And be greedy when others are fearful.
Mm-hmm.
This is a screaming time. I mean, we will look in our business. We've seen so many great mortgage firms be created in the ashes of 2008, right? I mean, unbelievable companies. And you just see it over and over. This is the time. And now I know many originators out there can hardly get their attention. They're so darn busy. They're doing a lot of refinance volume, but that's going to go away. And being able to bring value into this upcoming purchase market and touching them with the right stuff, it spreads like wildfire, right? And you have to bring this intelligence to the market. We haven't had the time, right? We're not meeting people in person, so it's a little bit different. But that inflation story and just having a working knowledge, the way it comes easy is you just have to get your arms around it. The way you explain something is you have to understand it through and through. And inflation is an easy one to get your arms around. It really is. And the great part of the unbelievable part of this, Eric, we don't know what's going to happen. We just don't know. Again, there's really smart people. Heck, the Fed is telling us. The Fed, who I'm skeptical of, I think they did a great job. And for us in the mortgage business, we should we should put a statue in our room, because they made our world really good this year. The Fed absolutely did. But for years, they talked about low inflation being quote unquote transitory, suggesting that, hey, this is temporary in nature. Inflation is going to get hotter. Mm-hmm. Well, they've since abandoned that, because you can't say something is temporary for 10 years. It starts feeling permanent. Right. So here we are now, and they're going to abandon this policy, and they want to have inflation run hotter, but they're still saying it's not going to be hot, maybe at all, for 4 years. Mm-hmm. Now, I don't know. We'll see. But if it's coming, you want to be a homeowner, and I would, that's one, just a nugget. Heck, we don't know what's going to happen. Right. But if you just bring that kind of position that to a borrower, because it eats away your assets. You don't want your money in the bank. You don't want, you would need to be in stocks and real assets, things that they joke you can drop on your foot, right? You're not going to drop your home on your foot, but you want to own it.
Understood. So what a great transition after you just said we don't know what's going to happen, to me asking you the question, hey, Bill, what's going to happen?
Yeah. Well, I'm on the inflation story further on. I don't think we're going to have inflation in the near term, in the next year, maybe even a couple of years. Why? Still have a lot of people unemployed, right? 10 million people unemployed. You mentioned the COVID threats coming through right now, which are just, the cases are rising exponentially. And so it's a real problem. And so with unemployment too high, there's going to be no threat of inflation in the near term. But when you look in history, you go back in the 60s, right? And you remember there's a lot of inflation in the Carter era. We had this monetary expansion back then, and consumer inflation, which is what we're talking about. Assets are going higher, stocks are going crazy, right?
Right.
We all own stocks, are going, homes are going crazy, but consumer inflation hasn't. Back then, consumer inflation ticked higher slowly, but then it went. Whoa. Now, is that going to happen again? It certainly can. And there's a lot of smart people that I follow and admire that think, that that's how it's going to play out. And even the Fed gives us little inklings, but they don't want to talk about it. See, the way
Right.
inflation works is the Fed came out and said inflation will be a lot higher. Man, it's going to already be scary. It almost self-perpetuates. It's like it's the expectations of inflation. So that's where I am on inflation. But I think rates will be, if you want to jump into the rate discussion a bit,
Sure.
I think rates are going to be amazing, not just next year, but the following years. There's such pressure on the Fed. The Fed is able to stimulate the economy just by pinning down long-term rates, right? I mean, the numbers are out there. The amount of households that can still benefit from a refinance are off the charts. I mean, this industry is going to be, flooded with opportunity. But even if inflation, we can pull up that chart if you want after.
Oh yeah, for sure. Let's do that. So those that are listening right now, we can talk through this, but those that are watching on YouTube, or we'll throw some of these clips up on LinkedIn. I'm going to share a graph, a chart.
Yeah.
So here we go. Talk us through it.
Yeah. So, I mean, obviously for folks that are in the business, that pricing does not come from the 10-year note per se, right? The 10-year note is backed by the full faith and credit of the Treasury and the U.S. government, whereas mortgage-backed securities is backed by mortgages. But if the 10-year note goes higher in yield, it's going to put upward pressure on the yields of mortgage-backed securities and downward pressure on price. So we have this chart up, and I drew a channel for you and Tom and the viewers here. We talk about trends, and what Mortgage Market Guide does is identify these trends. No one knows what rates going to do. I'm not sitting here saying I know exactly what's going to happen. That's baloney. But where we are rock solid is identifying these trends and letting you and subscribers know when the trend is over, right? And that's what you want to know. And this trend is very much in place. And so if you look at the lower left, you can see back in the beginning of August, the bottom of that bottom line, right? You can see that is a start. That was the lowest closing tick in the 10-year note, right? The 10-year note never closed below 50 basis points. It went to 31 for about 12 seconds, but it closed that day back in March at 50 basis points.
Right.
We tested it right here. And ever since then, you could see this chart. It's higher highs identified by the top line and higher lows, right? So, there's a saying, that's a trend that's not our friend. So here we go to the right side of the chart, and this is live as of today. We're at about 95 basis points or so on the 10-year note. If we get above these peaks at 98, now you can see what's behind it, 1%. That's a psychological ceiling. If we get above that, that could usher in some more selling pressure in the bond market. But here's the thing, when we talk about rates, I honestly feel that the Fed would immediately come in, commit to buying more bonds. Remember, they're buying $120 billion per month, right, to buy bonds. Or they will start to adopt some sort of forward guidance to get into like yield curve control, where they commit and they kind of pin down long-term rates. So, the rate story, I'm a mortgage banker talking to folks. You want to know the intraday changes. You want to know how things move, because again, just in the last few days, we lost 30 basis points in price in mortgage-backed securities. You want to lose that. But the longer term trend, it looks, like rates are going to be really nice for a really long time. And so I think housing, it's an inexpensive way for the Fed to support the housing market and get people's balance sheets in order, help them get into a home. But what the problem is, one of the problems that it's causing, Eric, is that it's pushing up home prices, right? We want to talk about how home prices slow down. Let rates get a little higher. That'll slow down the prices of homes. So, it's a catch-22. It's a really wild world we live in, but it's highly manipulated. And, I think it's going to have some consequences that many don't know or could even appreciate. One of them is it hasn't been inflation. And we're spending like crazy as a government. If you talk about the government, I'm a little fearful that this is now like, well, we're spending all this money. There's no inflation. Heck, let's go. Let's bring in some new programs and some more crap that we can throw money at and spend with reckless abandon. I don't think that's a good thing. And that's one thing that does scare me longer term. The ramifications of what that comes with. The fact that, they think you can spend like crazy without
Right.
any kind of ramifications.
So let's table that for a second. I want to come back to that, but sticking with where you were on the 10-year that we were just talking about, and just reading that I've been doing, and I wanted to ask you some questions about reports that the NBA put out, or it may have been Freddie or Fannie, I can't remember, or it may have been all three, and I'm just combining them all at the moment. But when we look at possible trends for 2021, and we look at Q1, Q2, Q3, Q4, some of those numbers are showing what will look like a 50% drop off in refinance volume as we get into end of Q2, get into Q3, which of course is going to impact an overall trend in volume, purchase and refi. So that's one thing I'd like for you to talk about for a second. Just your thoughts there. What is the pullback going to look like? And then drill down even deeper into purchases versus refis. Number one. Number two, there was something else that I had read associated with those numbers that related to, hey, we don't see a significant possibility of an increase in rates, mortgage rates, until the 10-year hits about 1.25. But then you just shared something interesting, which is your thoughts about when we start to get around that one number, and then what does the Treasury do to impact that number and keep it low? So can maybe start with, do you agree with what some of the reporting is showing right now relative to the pullback for next year? Talk a little bit about purchase to refi, and then maybe you don't need to talk about that 1.25 number because you kind of already did.
Yeah. So the refinance, I see rates ticking up a little bit from where we are. So the baseline, that's where we feel rates maybe a little bit higher from where we are now, but not much. Not much. And I do think the purchase business is going to be just as fast as people can build homes, as fast as they're going off the shelf. And I think more people, as COVID, read tea leaves, as people feel better about life, I think more homes come on for sale. People are moving out of states. I live in New Jersey. I see folks from my friends in New York, like there's people leaving New York City in droves. I think that's a tailwind for years, Eric. I mean, you're near big cities. I think that's a tailwind for a long time.
Yeah, I mean, look, to that point, and not to interrupt you, but to that, don't you love when people say not to interrupt you when you just interrupted the person?
I constantly do that. Sorry to interrupt.
Yeah, sorry. I should say sorry to interrupt, not to interrupt. That's the wrong thing to say. To that point, and I'll ask you later to talk a little bit more about geography and what that impact will be to the broader economy. But Thomas Seelbinder sitting here with us right now, he was Orange County, and now he's in Hickory, North Carolina, and his life has changed dramatically, by making that move. So to your point, markets like ours are going to see the benefit of all of these things because we've got New Yorkers and folks from California and others moving to these smaller towns. So no, I digress a little bit because I want to get back into what you're seeing purchase to refi for next year, but that could be a healthy thing, I guess, for the overall mortgage industry, but it will negatively impact local markets.
Yeah, markets will be affected. It'll definitely, like real estate, location. Some will be affected, some poorly, others will have very positive outcomes. The refinance share is going to drop off sharply, but I do think it's not going away. There will be a big chunk of it'll still be a historically big chunk of refinances, but the purchase market's going to more of a make up for it. It's going to be a multi-trillion-dollar year. It's going to be one of the top 3 or 4 or 5 years ever. So and I think that goes into and bleeds into 2022. So it's okay if some of the refinance goes away. Frankly, I speak to a lot of folks and they're almost ready for a break, right?
Oh, for sure. There is exhaustion for sure in this industry.
And not that you want it, right? But you don't want to wish for higher rates, but I think it'll come out. But I think it will be just incremental. And to your point, that's interesting. You talk about 1.25 on a 10-year note. Maybe that's the number. But psychological one's 1. You get above 1, all of a sudden, right. Oh, wait, 1%, and the yield curve is steepening. I think the Fed does more, and again pins it in, and you have a low, sub 3% mortgage for all of 2021. That's a great place to be.
I refinanced in March at 3.5, and I thought I had won the lottery. And now I'm the big loser.
We probably do it again.
When you compare it to rates before, I mean,
the first home that I sound like my parents now when I'm talking like this, but when I purchased my first home, when Nikki and I purchased our first home, I don't remember what year it was, but we got 7.5. And I thought I won the lottery then because rates had been coming down.
Yeah.
We didn't stay in that house very long, but then since then, you know, every time we've either purchased or refinanced, it's just been lower and lower. And 3.5, and my home's not an expensive home and the mortgage is not very big. So 3.5 on that number is almost free money, which then allows me to leverage other things. And to your point, Bill, allows me to leverage other things, whether it's investment in my business or investment into the markets or investment into my kids' college fund so that they don't come out with debt when they come out of college.
Right.
1 + 1 doesn't equal 2 when you manage the math and the formula effectively, like the way that you describe it and educate it, Bill.
Yeah. Well, here's another thing that can help us on both the interest rates. I mean, it's a tailwind to housing here in the U.S., but it's also for the refinance activity. When you look around the globe, you know, the bond market is global, and there's really only a couple big ones. So if you look at the 10-year Bund in Germany yielding, I don't know, it's like minus 60 basis points. When you look at our bond or 10-year note yielding 95 positive, you know, that's a chasm. We look attractive. So the money will continue to go into our bond market. And if rates become more negative, and you know, what scares me is you're hearing people like, you know, the Bank of England saying, well, maybe we go negative with our rates. It's like, geez, that will pull the 10-year note back down more. And then it allows for mortgage-backed securities to you know, chisel away and you know, a little bit of margin compression, right? You can get in there and you can chisel down some yield compression, I should say, and chisel down some rates. But and that'll be a tailwind for forever. Remember, out of the last recession, Europe, because of their fabric, right? You have all these member states trying to coalesce around a currency, and they don't have the political will to get people. So they had a tough time coming out of the last recession, and they're repeating the same mistakes this one. They are not doing the meaningful things on the fiscal side because they can't, and they're not throwing enough money at it. So because they're going to limp along, maybe be in a recession, we will be the beneficiary by way of, you know, money coming into our dollar and supporting our bond market.
Do you think we're past the point of some of the theories that were thrown around within the last year or so that we could ultimately end up getting into negative territory?
Well, it goes back to the point I made earlier about the darn government, you know, finding out that they can, we could spend stuff and it does push rates up. You know, we're going to find out today. You know, here we are on a you know, Wednesday together, you know, 1 o'clock Eastern. The Treasury, part of this problem that we have is all this stimulus. It has to get paid for, right? The CARES Act was 2.2 trillion. We are already underfunded by $1 trillion, right, on an annual basis. And now they're talking about another, what the hell's another 1 or 2 trillion? So that also gets sold in the bond market. And it's like when a stock does a reissue, right? They deploy another amount of shares. It depresses prices and increases rates. We are going to find out today how the bond market likes it. It hasn't been liking it. And remember, we're at the start of this. This is another whole other story we can be down. We only started paying for these bonds, for this stimulus now, and there's more stimulus coming. At what point does the market say, hey, you know what, like a borrower, you know, Eric, you got too much debt. I can't, what do you got? You got to pay a higher rate, right?
Right.
And so what's happening on the other side is the Fed is buying bonds. So we're spending and the Fed's buying them. It's lunacy. And so I heard one Fed governor or Fed president say, you know, maybe there's a case for negative rates. I was like, what?
Yeah.
No, we don't want that. I don't know how that works. You know, that's turning the banking system upside down. Not sure that's going to work. And how you get out of it.
Stick with something you just said for just a second. You went into stimulus and the CARES Act. I'm curious, and one of our teammates had asked the question when he knew that I was going to be talking to you, just questions relative to CARES Act and forbearance that was put in place. And and just the overall stimulus, do you feel like that is masking some numbers that we really don't see right now, whether it's current or future defaults, or talk about that a little bit, and then maybe project 6 months down the road, 12 months down the road. Did we just kick the can with a lot of those people?
Remember, you know, it's interesting, and that was a good question the person on your team did ask. You know, with the storms, remember we had the storms of 2017. No one even remembers them, right? forbearance was as high as it was with COVID. Remember,
Hmm.
there's millions of homes at risk with that. And you can't go back to your house. You got to leave. You got to wait and see. Your mortgage still got to get paid. And so, forbearance went high then and it disappeared. I mean, get me wrong, forbearance is 60 times right now what the normal rate would be, but the government continues to throw money at this problem. Whether it was PPP, it was all these different things to try to
Right.
keep things afloat. I think there will be another round of it. I think that with forbearance, I'm very optimistic, especially with home prices. As the housing market stays strong, which is check, that's a base case. I think it stays strong for a while. If we continue to put on jobs, right? The jobs is the big thing. Out of the forbearance numbers. So anyway, let me stay on that thread for a
Well,
second.
but and that is the big thing, right? Because the difference between the storms. So I've got a good friend who we've had on this podcast, Brock Long, who was the former FEMA administrator, the first one under Trump. So he went through Houston, he went through Paradise in California, and he went through Puerto Rico. So I understand your comparison there. I would think, though, the difference, though, is that the jobs for those people weren't impacted like they are today.
That's exactly right. That's exactly right. But so the good news is, if there's a silver lining in this elevated forbearance, about 25% of them or so are more quote unquote strategic. They have it. The mortgages are being paid. So 25% of them are being paid because they have a job.
But they have a parachute. They've got a little bit of potential parachute.
If they need to do something, they can take advantage of it. And that brings us into what's happening now. It's about jobs, jobs, jobs. And we actually have this torrid rise in cases right now, COVID. And what I'm fearful of is it will have a negative impact on the labor market, and more people lose their jobs and people get shut down, and then it gets into more forbearance. So this little 60-day window will be very interesting. It's a tug of war between this crazy rise in cases versus widespread vaccine distribution, more therapeutics, more vaccines. And so we're going to have to hunker down for 60 days. But I do think ultimately at the end of this, the government underwrites the whole thing. And does it mask it? Yeah, for sake of a better term, yeah. I mean, I'm a part-time, I'm a partner in a nightclub in LA. Great time to own a nightclub, right? And so,
wow, no kidding.
So so you, but they give you PPP, and I watched it. It was a mess. I mean, it was the first one was just throwing checks all over the place, right?
It was like wartime stimulus.
It
just
was
go do it.
Crazy. Just throw helicopter money, throwing it all over the place. And so I think it'll be more targeted, but there will be more. I think the forbearance gets underwritten until the labor market comes fully back. And I'm optimistic that the outcomes at the end will get past it. I think the government's going to eat a lot of it, though. Like you said, it's going to mask the problem, but and it'll wait for the jobs to be there. They will keep underwriting it. Remember, we have those bonus checks that allow people to pay. I mean, the government's throwing a lot of money at this, Eric. It's crazy. I just don't know how we pay for it. I mean, we're not going to pay for it, but I just don't know what the outcomes are later. No one knows.
There's so many tentacles to this, right? Because from a purely math perspective, with no emotion, we can run the numbers and see that they don't add up, that it just doesn't work. However, when my buddy who works at a machine shop, who has a small home and a small piece of property, and his wife is an educator, let's say, and they've got a couple of kids, and he just lost his job at the machine shop that took PPP money, which kept them floating for 3 or 4 months, but didn't solve the problem. And now he doesn't have a job. And then his unemployment benefits went away because the stimulus ran out on the unemployment side. On the one hand, we can say this isn't feasible. On the other hand, we can look at our community, and it'd be very difficult to say we shouldn't do anything. And I know you agree with that. And I think that's the tug of war that you probably end up in a lot, because your brain is so economic focused and it's math. But then there's a nuance to making sure that we support our community in a way that I think about, so we got the new administration coming in, and you've talked a lot about that already. And so if there's more you want to add, I would love for you to do that. But I was joking with my dad the other day about well, I'll just say it. So Bob Dylan, I think we saw just sold out his entire library for $300 million. Now, I have no idea what side of the political aisle Bob Dylan sits on, nor do I really care. But I'm a little bit like you. I see this as a case study, and I text my father just just joking around. And I said, hey, Bob Dylan was smart enough to go ahead and sell out before our capital gains tax. And I was semi joking, but with the new administration coming in, and no, this is not a negative position on Joe Biden or his administration. I'm just making an economics point that if the capital gains taxes go up, good on Bob Dylan to go ahead and sell that now. But then it got me to another thing in my brain, which was, if a guy like that saves significant amount of money on capital gains, do we believe that the human instinct is then to go reinvest in philanthropy that will support the greater good? I just wonder about these things. I'd love to have a conversation with Bob Dylan and say, if you just saved $50 million by doing it now versus doing it in February or whenever, did you invest that back into the community? I don't think I'm asking you a question. I'm just sort of talking out loud right now. Like, I'm intrigued by how when we pull these levers too hard in one direction, we don't allow people to make these investments into their local communities.
Yeah. That could be a whole interesting conversation, taxes and how, who uses it better, but we won't get into that one because
well, I can't. You call Bob Dylan, see if he'll come on with the three of us, and we'll ask Bob Dylan how he's spending that extra money.
Generally speaking, it gets passed around and they control it, and but you see it, people move, and when taxes become onerous, and they take action. It's real easy. I mean, New York City, you're watching it. I mean, they're adopting these new taxes, and they're just chasing people out. It is what it is. It's happening.
What do you talking about geography? What project that out a little bit? What do you think markets like Southern California and New York City look like? I'm
New York City is my dad
talking about moving to Florida, and I mean it's all over the place.
New York, I have good friends that moved to Tennessee, Florida, Texas, right here in my neighborhood, and
Hickory, North Carolina.
North Carolina, yeah. I'm actually looking down there. Yeah, so you see more
Bill.
and more. You're seeing more and more and more of it. You want to protect your asset, and some of it, people don't mind paying taxes, but I think when it gets, and it doesn't make a difference what political spectrum, because we're seeing people on both sides of the political aisle saying, California, you know what, I liked it here, but I'm not getting enough for my money. So Elon Musk was this morning. He's gone now. We went under the hood, and why is it? Because he's going to get this multi-billion-dollar payout. If he lives in California, he's got to pay a really large tax bill. He relocates in Austin, he gets a pass. So, money moves. I want to go back to one thing in a second, though, because you talk about stimulus in the administration.
Okay, sure.
Because when we talk about all these great stuff that's happening, I'm actually watching a TV across from us and what's happening. Stocks rolled over. And why? Because we talk about stimulus and helping your neighbor and all that stuff, and how we get beyond this. The real threat, I think the major threat to all this is that we don't do enough stimulus. We're going to have to do more. We got to do a lot more, and we got to get through this. And just today, like the stock market hit an all-time high, and then McConnell was just out an hour ago saying, hey, you know what? There's he kind of alluded that there's a chasm between both parties to get something done. And we virtually joked this morning saying that, Lloyd Christmas and Dumb and Dumber. So you're telling me there's a chance? We keep joking because they've been kicking this stimulus package around for 2 months, right? And they still haven't got it done. But now we're joking like there's a chance that they get this done by the 21st. Because if it doesn't happen by the 21st, we go into congressional recess, and then it's a mess. And we kind of joked, said Lloyd Christmas and the markets won't like it. And so he made a remark, and stocks are now nicely negative and reversed a few hundred points. I think the markets would be, if we don't get a good stimulus package, I think stocks will get punched in the face. And it could be the reason to kick off a sell-off. Right? I do think it's going to get done, but it's terrible to watch the sausage get made. But I think longer term, I think the stimulus is the big thing. That, like, if they pull the plug too early, and then that goes into the administration, this new administration. Janet Yellen was a phenomenal pick, and that's why stocks rallied on her being nominated, because she's a known commodity. She knows the Fed, right? She knows the inner workings, so she can work with the Fed. And then finally, she's very dovish, right? She doesn't mind throwing money on a solution. So I think if you read the tea leaves, the Fed wants to do more, the Treasury wants to do more, and that's why I think stocks continue to go to all-time highs. But it just shows you the turbulence and the volatility. McConnell makes a remark, and it could have been taken out of context, but markets roll over just because of these news items. And that's why, people on this call need to be watching this stuff in real time, right? Like, what did bonds do? Bonds didn't do anything. Why? Because they realized something's going to happen. Stocks they're like salespeople. They can get, ADD. They can jump into the moment, but bonds are a little bit more realistic. Bonds haven't moved on this news yet because I do think the stimulus package is coming, but we got to watch this turbulence.
Yeah, no, great point, and brings me back to just a couple other topics I want to touch on, and
Yeah.
then we've gone a while, and I know you've got a hard stop. You told a story early, and I don't know if it was before we were actually recording or not, but it was about you giving a presentation, and a loan officer that was a top originator really didn't understand pricing and its correlation to their business. And so one of the executives of this company came up to you and said, I can't believe one of my top originators doesn't get that. I'd love for you to talk a little bit about that, and maybe where you're seeing. Well, I mean, look, you already do it, Bill. That originator can leverage you and Mortgage Market Guy and Tabrasa to support some of those efforts. Do you think this is something that you're seeing on a broader scale, where we've just got really good salespeople in this industry that aren't truly advisors for life to their customers? And maybe just talk about that for a second, and some easy solutions to that problem.
I think now in this market, it's very easy to, for the sake of a better term, to get a little complacent, right? It's fallen from the trees. We're making a lot of money on the transaction. Even the borrower, quite frankly, Eric, probably not even interested sometimes. It's all about rate. Right. So it's in those other conversations, a long-term purchase, or you're speaking to a renter that's, considering, but they don't know if they can afford it. That's where you have that inflation discussion. But I think that, it's easy for salespeople to get a little complacent when things are fat, right? We're fat and happy right now, but that's going to change. It's going to change. And more importantly, we have to, as we go into 2021, where it's a much more purchase driven, it's a longer sales cycle. A refinance is like a transaction, right? A purchase is like you're selling somebody a home. It's a big deal. Give them everything. What do you plan on doing? You plan on saving for college after this? What does it all look like? And where are you putting your money, right? Money should not be in a match. So everybody on this call, you have money in the bank, got to take it out, put it to work, because with inflation and rates, what they are, you're losing money. So I think, I think as we go into next year, what a loan officer should be doing as this market does change, and it's changing already, work on this stuff and get just a working knowledge. And the great part about it is it changes every day. What we talked about now, in 1 week, some of it will be ancient history. It will even be viable, right? We don't know what's going to happen, but being on top of this stuff. And if you just give a couple of nuggets, I think you make an impact. I think what we fail to remember is that when we talk to somebody and you give them a nugget, we don't appreciate what we show them. They may go away and you say something and it leaves a mark, and they tell 3 other people, and that's how you get business, right? But if we're just wheeling and dealing, closing and close on time and do that, that's what everybody's doing. That's what you got to do.
Yeah, it's sustainability, right? It's putting yourself in a position to be sustainable through any market condition, to be an advisor for life, and to leverage the tools and resources that you have at your fingertips to just simply make you better at doing what you do, just on your own. And obviously, you have a tool, you have the resources. We started Model Match as a solution for that reason, to put mortgage companies and other companies, as we go into other industries as well, in a position to leverage what they're doing on their own, to be better at it by having a tool and a resources that can create what you said earlier, which is efficiencies, right? Bill, this was awesome. I see us having a part 2 and a part 3, and maybe we even just start doing this on a monthly or quarterly basis and doing like
anytime you like. I love it. I love talking.
Do like
Bill Bodnar show.
Yeah, we'll do like a Bill Bodnar kind of walk podcast show in combination.
Like Johnny Carson, and like Bill just comes out, right? And he has that whole
think of another
vibe.
Comparison. I don't want to do that. I'm just kidding. No, but we should get together more often, even if we do a skinny version of this at 5 or 10 minutes and throw it out there. I think it's highly valuable. If I'm going to post this and make sure people know where to find you. Is there anything you want to throw out there if somebody wants to hunt down Tabrasa and Mortgage Market Guy and Bill Bodnar?
Yeah. Well, if any of this is interesting, you could shoot me an email. I'll be happy to answer any other questions you might have. It's bill@tabrasa.io. Shoot me an email. Love to talk to you. And if there's things we can do to help you and or your team, give me a buzz.
That's awesome. I've got one last question that comes from my father as we end this, and that is, do the New York Giants make the playoffs?
Geez, almost by default, right?
I didn't ask you by default. It was just a simple question. Do the New York football we got a yes from Bill Bodnar. My father's going to have a really good rest of the week until we play the Cardinals this weekend, and then we'll figure out what happens from there.
How did they beat the Seahawks? I mean,
I didn't even pay attention to that game. I was somewhere else and got a text message from my father, thanks Dad, that just basically said WTF and a bunch of emojis. And I thought they either just got slaughtered or they somehow figured out a way to beat the Seahawks, which is proof that anything's possible.
That's a great story.
Hey, Bill, hang out for a couple more minutes. We're going to break, but thanks for joining us on the Walk podcast. This was great. Thanks for spending some time.
Loved it. Thanks, guys.